way, folks. There's only one way to describe this market, and I always like to refer to it as the trend is your friend, because we come into this phase of a self-fulfilled prophecy. People want to make money, and if the lemmings are running into shorts and selling stocks, you damn well think you're probably going to end up doing the same, because money goes where money goes. Just like when the market was running up, values mean nothing. The market's all fugazi. Doesn't matter if you're a value investor or a trader. It's just all technically based off supply and demand and how we feel in this current moment. But there's some anecdotes here. There's some really important anecdotes that you have to understand, because I'm listening to so many people right now on CNBC trying to tell you it's doom and gloom. It's the end. We're going to see a 30% drop, and it's just like going to the upside. They don't effing know. So stop pretending like data coming from the Federal Reserve is going to change this. Even if interest rates start to peter off, we see inflation come down. Yeah, those are good catalysts to start turning the market around, but that doesn't mean anything, because the market can turn at a drop of a dime before a recession even ends or starts. And this is a great anecdote here. The S&P 500 surprisingly rose an average of 1% during all recession periods since 1945. That's because markets usually top out before the start of recessions and bottom out before their conclusion. In other words, the worst is over for the stocks before it's over for the rest of the economy. Because again, this is like trying to play earnings periods where you know they're going to post great numbers. And I mean, we had like years of great numbers, right? But sometimes the stocks go down on good numbers. Sometimes they go up on bad numbers, because you just don't know. You don't play off that crap, because you'll end up ruining yourself investing in these markets. So we're going to go over a lot of stuff. I spent over $20,000 today because I'm an idiot. I don't cost average. I just spend it all at once, and then I lose my mind trying to sell stuff. I talk about that all the time. But let's take a look, guys, because I did dump a pure 20,000. I actually spent a little more than 20,000 today, but about 20,000 the S&P 500 index. Who knows if we go 30% to the downside? I don't really know. Don't really care. Just want to get about 100,000 divvied up between the SP 500, the VYM, the dividend ETF in the US, and then another 100,000, which I've kind of already got into. VDY, I think, is the ticker for the Canadian index. But look at the Qs here, guys. Like a zoom in the year to date, down 30%, just wild. Vanguard, the Canadian index, kind of representing like the S&P TSX 60, so the Canadian economy of the S&P 500. Jumbly words there for newer investors, but down 7.98%. I think the Canadian economy has performed so well through this, just like VYM has, because they're mostly dividend stocks and things like oil, commodities, safer haven investments for most people, right? But aside from safe haven, let's talk about the tippity top of that iceberg of where people thought their money would have been safe this year. And obviously Apple, something, again, I get criticized a lot for selling out of these companies and constantly shifting around. I don't know what I'm doing here, guys. I just try and do what feels right, and I change all the time in and out of these things. Like I change my underwear, and it works for me, right? It tends to work for me. I mean, I'm still down a lot less than the overall market is here, but Apple's definitely becoming a big proponent to this kind of sell-off. I think Microsoft's down roughly the same, but the ones that are getting hit the most, definitely Amazon, down 36.22%. I've been watching so many YouTubers using these things as like savings accounts, and I just don't understand it. I always feel like these pure play growth companies are probably some of the most risky. You got to be really careful how you allocate these, because if you ain't getting paid cash flow as much as people are like, I'm all about total returns. I'm like not giving up on dividends, but I want my dividends to come from ETFs. So I don't mind losing out on the $1,000 a month I'm making to capitalize on that total return. But if all your money's just interjected into the total return and growth, this is not a fun period for you, especially if you have job issues because of the recession. You're going to have a hard time cost averaging into this market. It's a balancing act. That risk tolerance, time horizon, how much money you put away a month, that really comes into the details of these companies you should be buying. Tesla's another one, down 40%. Tesla's a really weird one, right? It's like Nvidia to me, these kind of growth companies that have really high values that value investors will never wrap their heads around are incredibly hard to buy, because you can make any projection you want into the future and it could be right, but God knows the future changes very rapidly, and you can't just be placing price targets on things like this. If you love the company, you buy it, you set it, forget it, come back in 20 or 30 years. It's all you can do with companies like this, right? PayPal, man. Whew, baby. PayPal's something I've watched. Don't really care for it, but it's crazy that it's down 62.88%. I hate PayPal. I've talked about this in the past. PayPal is like the fee goblin that just crawls up your ankles to take every money they can from you. Because, I mean, I was dealing with U.S. conversions, and I can't just pull out U.S. currency from PayPal being a Canadian. They make you convert it. Whereas my bank's like, no, keep the U.S. dollar. Don't pay the fees, which is weird for a bank, considering PayPal should be more progressive than that. I had a conversation with PayPal about that, but Meta, my Facebook, another one that I got a lot of controversy over. This was one of the ones that hit me the hottest. This one slaughtered me, and I know I'm probably going to regret selling out of these in the future. But again, it's not like I'm out of the market. I still technically own them through the indexes, but I can't get over Meta right now. Look at this, down 53% here. I know when it dropped, scared the crap out of me, that earnings period like 2 quarters ago. When this thing dropped, I sold out of a lot of it. I bought some of it back in the 240 range, and then I ended up selling, somewhere around the 220. Anyways, I ended up selling all of it, and again, it's working in my favor a little bit. But when it comes to Facebook, guys, to disconnect from this crazy reality, at least they give you the VR, which luckily Mark Zuckerberg released a new prototype today, talking about this kind of concept for a new VR headset called HoloCake 2 and Mirror Lake. I don't really get. Can't you just stick to Quest 3, Quest 4? Like, at least keep it in tandem with the marketing, right? But either way, if this comes out, which I don't think it will because it's prototype, but if they come out with a new VR headset, I'm desperately waiting. I will buy the new one. I put my hours into it. It was worth every dime I spent on that sucker. So I'm still looking forward to the future that Meta is providing. We'll see what the next quarter brings for things like Google, Facebook, the marketing side of things in a recession. I think people are anticipating some bad things, but we'll see what those quarterly reports bring as we get through another quarter period here. But let's talk about the precious metals, the safe havens, the place every YouTuber, including I can't believe Jeremy from Financial Education, buying silver ETFs, which to me is just moronic. I like gold and silver. I own some, don't get me wrong, but I think they're completely disconnected from any past history they've ever had. And again, people don't take the long view of gold. If you scaled it out over the 2,000 years of its history, the rate of return is in like the 0.000%. This thing growth-wise, again, look at the long chart of gold, right? I mean, if you're looking for growth, you're not coming to gold. It's just utterly abysmal. Like, we're barely trading back toward its 2012 highs, guys. It's been 20 years. It's been 10 years. 10 years and nothing has happened here, especially if you bought at the peaks of 2012. But what I find most interesting is when people buy this, they show you the same story of, it's used in things and it's, there's only so much of it. But the weird thing is they wanted to just flood the market. It's one of the most manipulated markets. Most people don't know that. Mines, I deal with a lot of miners. And they control how much gold they take out of the ground. Like, you don't think they could just pull it all out of the ground at once if they wanted to and just flood the market? You don't think all of the paperwork and all of the paper, gold and silver that's in the ground but traded on paper doesn't manipulate the market? Like, it's so insanely manipulated, and no one can tell me how much silver supply there is in the ground, what the outtake is, how the demand and the usage in parts is on a global economic basis. They just give you the same shill story that's been around forever, and you should just own some of it, but nobody can actually tell you the economics behind how these trade, because they're so bloody complicated, which is why in a market like this over the last quarter, it's weird that gold is trading down, because clearly all them gold bugs don't know what they're talking about. It's not like it used to be, my friends. History rhymes, but it does not repeat. In an inflationary period as great as the 1980s, why isn't gold performing like it was in the 1980s? But we could also talk about crypto right now. I did buy some crypto today. I've been buying Bitcoin, one hell of a volatile asset. The only thing I like about Bitcoin, even though it's volatile as hell, unregulated as heck, it's actually understandable from a supply metric. Unlike gold, at least you understand the supply and demand metrics of this weird digital currency that does, for you haters out there, does have, some use cases when we're talking about international money transfer, something that I understand fairly well at this point. So I've been buying Bitcoin, yeah, but when you look at the short interest in it, guys, very fascinating stuff. Very fascinating. This is the lemming effect, the self-fulfilled prophecy. The trend is your friend, because the short interest across all these trading platforms right now is pretty immaculate, at half the trades going on being short. It's kind of wild. So this would be a good dynamic to understand why crypto's been able to fall as heavy as it has, and why most stocks are probably falling as heavy as they have, because people just follow the money. If the money says it's going down and that's how I got to make it, that's what I'm going to do, right? And a lot of private equity funds do not have to share short positions, so it's very hard to understand how many people are aggressively shorting the markets, right? So this is just, the metrics behind crypto to me are so much more transparent than gold. And if you want to learn more, not that I'm telling you to buy crypto, but if you want to support the channel here, I love this write-up. I partnered with a multi-millionaire. You guys have seen him on the channel, but he wrote another blog here called Cryptocurrencies Preparing for a Bloody Massacre, which I find very intriguing. This is free to sign up to. I make a little bit of money, cost you nothing, supports the channel. I'd highly appreciate it, as things are wicked wild in my world, and I want to bring those stories to you, but I got to be patient. Let the cards lay out and then tell the story later, right? But taking a broad view of the market here, guys, it looks great. it looks great until you look at your portfolio, which mine is still down probably like 60 something thousand dollars. I try not to fixate on the overall number and just focus on that risk tolerance. So yeah, so basically bought a little bit of Bitcoin today. I wish I could have picked it up when it dropped below the 20s, but primarily all of my real money is going into these index funds, at which I'm going to set up on a drip. As I told you, my 4-pillar kind of strategy here is primarily dictated around VOO, VDY or VDY, VOO, VYM. Is it VDY? Let me look it up real quick because I don't even know. But yeah, the VDY. So VOO, VYM, VDY for that Canadian area, and then of course my speculative, my individual stocks, and those are the 4 buckets I'm playing within. And you'll see that I'm more aggressive toward the indexes right now. Set them up on a drip, let them continue to fill themselves out, and then just start hinting into these little growth plays, which I've mentioned: Baba, Google, crypto, all this stuff, right? So it'll be neat to see how this pans out. If you want to see how it pans out for me, I will obviously update my portfolio as I do every week on this channel. So consider subscribing, because at least I will point out the self-fulfilled prophecies and let you know that, hey, don't listen to CNBC, baby, because like I said, the recessions could end tomorrow. Well, the market recession could end tomorrow, but the recession could still be happening in your backyard. The entire real estate economy could collapse, or maybe it doesn't. Who the hell knows? So don't play like people know. It's fun to pretend like you know. That's what CNBC does. And I wish analysts could be held responsible. Only 2 jobs in the entire world you can't get fired from: weatherman, analyst. Stock analyst, you could be wrong every day of the week, ruin people's retirements, but hey, you still got a job. You still get paid, even if you're losing someone's money. Gotta love those fees, right? The mutual fund fees. But stay cool, stay awesome. And as always, I look forward to catching you in the next one.